Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies' SoFi stock and why the share price has pulled back by around 11% during the month of November. After that, we're going to move on and talk about Palantir Technologies' PLTR stock and why this company is trending right now. And then lastly, we're going to move on and talk about NIO stock, ticker symbol NIO, and why it has recently surged and then pulled back in their share price, and we're also going to analyze these companies to determine whether or not these are good buying opportunities right now, considering the current risky macroeconomic environment that we find ourselves in right now. So for more videos on SoFi Technologies, Palantir Technologies, or NIO, remember to go and smash that like button right now, comment your thoughts down below about any of these stocks, subscribe if you are new, and without further ado, let's jump right into today's stories. SoFi Technologies is a fintech company or a financial technology company that offers their consumers an all-in-one inclusive digital app that gives them access to various financial services and financial products. So essentially, SoFi Technologies is a very innovative digital bank, and their current share price trades at around $4.50, while professionals in this space believe the company should be trading between $5 and $10. SoFi Technologies has been the talk of many investors, specifically because they have lost around 10 to 11% of their value regarding their share price in November. The company has been facing a number of various challenges, including a very negative macroeconomic environment on top of less than ideal third quarter earnings. Another thing that didn't help the company is that during 2022, unprofitable growth companies and risky singular growth stocks performed very unfavorably during this time period, where many stocks, including SoFi, have dropped by around 70% during this time period. And that's why currently the current share price is dropping lower and lower, because analysts as well as investors are taking more of a risk-conscious approach because of the current negative macroeconomic environment, which I think is actually pretty smart. So far, the SoFi share price has dropped low enough to where the market cap is around $4 billion, and this could be a good buying opportunity, but many professionals believe this company could drop as low as $3 per share before the management implements a reverse stock split, which would initially give this company some momentum where the share price will increase, but then shorts will come back to this company in large numbers and then try to get the stock price even lower. But that would give us a better buying opportunity. Because if we look at this company fundamentally, they are still strong even though the current share price is falling. For instance, their member count is now over 4.7 million according to the third quarter, which equates to a 61% increase year over year. On top of that, they have a 69% increase in their overall products because they've been cross-selling to these new members to where now they have products numbering around 7.2 million. On top of that, their revenue reached 423 million for that same quarter, or an increase of around 56% compared to last year. So if we're looking at their overall membership growth, the growth in products, as well as their overall revenue, this company is still doing fine. But investors are less than enthusiastic about this company despite its strong growth. The main reason why many investors are taking a negative stand is mainly due to their net loss, which more than doubled from $30 million last year to around $74 million this year. So until this company moves itself more toward better financial results and profitability, investors aren't going to be satisfied. Now, what I want to point out to investors is that SoFi actually has been benefiting from the negative macroeconomic environment, because as the Fed increased interest rates, SoFi and other financial institutions actually benefited from higher interest rates because it increased their overall net interest income on the loans that they have out. And this has then offset the lack of demand. On top of that, their loan volume has increased as well. And I think this article is trying to refer to their personal loan volume has increased, because their overall loan volume definitely has not been positive, and I'll tell you why. For instance, you had the extension of the student loan moratorium, where various people no longer have to make payments on their student loan debt, which is negatively impacting SoFi, because SoFi has a student loan refinancing business, which has literally decreased in their overall volume of loans by around 50%, particularly in the third quarter. So this student loan moratorium, which has been extended until June of 2023, has hurt this company. On top of that, because interest rates are increasing, this has negatively impacted their overall home loan origination volume, which has decreased around 73%. So these are all negative macroeconomic factors, which hopefully will be ironed out in the next few years. But overall, there is still huge growth potential in this overall company as they continuously to upgrade their products, gain new customers, and grow their overall revenues. The company is growing their revenues at a very impressive rate still, despite the student loan moratorium being extended and various loan products of theirs being less popular now. So technically, as of right now, considering the current macroeconomic environment, there's no rush to buy this company. The best thing is to either wait, hold, or put this company on a watch list until after the reverse stock split goes through if the share price drops that low. But there are very bullish, positive investors that don't believe it will hit $3 per share, but we're going to have to wait and see. Right now, technically, the company is trading at a pretty good discount, only around a $4 billion market cap, but we'll have to see in the future of what this company makes for itself. We also haven't had a reiterated time frame for when this company will become profitable, because the old forecast is that the company was supposed to become profitable at the end of 2024, but with the extension of the student loan moratorium as well as negative macroeconomic factors, I think it's going to change to the beginning or middle of 2025, which is when this company could achieve profitability. With that being said, let's move on to why investors are talking about Palantir Technologies PLTR stock, which currently trades at $7.30, while professionals believe the company should be worth anywhere between $5 and $15. This company is a big data and analytics company that serves both commercial enterprises as well as government clients. Palantir has ranked itself as one of the most searched stocks, and that's why I'm reporting on this company, because as of right now, I think the company is overpriced according to current financials. For instance, the revenues that this company is bringing in is very comparable to what SoFi Technologies is bringing in. However, SoFi Technologies is trading at a much lower market cap, only around $4 billion, compared to Palantir, which is trading around $16 billion. So you would think that Palantir is bringing in or growing their revenues by at least 4 times what SoFi is doing. However, that's actually not the case. SoFi is growing their revenues even quicker than Palantir Technologies, despite Palantir having a much larger market cap. So this means one of two things. It either means that SoFi is radically undervalued or Palantir is radically overvalued. And I think it's a little bit of both. However, the main reason why investors are diving into this stock and researching it more is because there has been rumors circulating in the media that this company is trying to revamp and change their overall business model and business prospects. However, as of right now, I couldn't find any concrete data that is not just speculation. Now, what we are going to look forward to is that for the current quarter, Palantir Technologies is expected to post earnings of 3 cents per share for their EPS, also known as their earnings per share. And that would indicate a very bullish positive change from a year ago of around 50%, so that is very good news. However, for the current fiscal year, the consensus estimate for their overall earnings per share is around 4 cents, and that would be a change of a loss of almost 70% from the year prior. So clearly it's going to be a mixed bag here. However, for the next fiscal year, the consensus estimates for their EPS is supposed to be 15 cents per share, which would indicate around a 273.3% increase. So if you can hold on until 2024 and beyond, this could be a good buying opportunity, but I do think that you could get a better price point for this company. This company could fall as low as $5 per share, so always keep an eye out for that. Right now, analysts and professionals just have a hold rating on this company because we really don't know what Palantir is going to be making of itself over the next few years. But I hope they can grow and scale their overall earnings, which is going to do great things for the overall stock price, and it's also going to tell investors that they have good financial health, because arguably earnings is one of the best indicators of the company's financial health. However, we do need to keep an eye on their overall revenue. For instance, their consensus sales estimate for the current quarter regarding their revenues is $505.9 million that they're supposed to bring in, which is a year-over-year change of 16.9%. And honestly, this may seem like a good number, but it's not. We have seen estimates drop from a 30% CAGR down to a 25% CAGR, down to a 20% CAGR, down to a 16.9% CAGR. And that's not good. We see that they are slowing in their overall revenue growth, and that's not what investors were promised. For this current fiscal year, they're supposed to total around $1.9 billion worth of revenues, and for the next fiscal year, they're supposed to bring in around $23.3 billion, which would equate to around a 23.4% increase and a 21% increase, respectively. However, all of these increases and growth rates are below what management promised investors, so that has clearly left a bad taste in investors' mouths, and that's why I believe the company's share price is going to fall. Now, remember, we have to adapt to the current news updates. So when we first started to report on this company, they were saying and projecting growth of 30% in terms of their overall revenues from 2021 all the way until 2025, and that was absolutely phenomenal. But as time went on, you can see that the company has actually revamped and reiterated their overall growth rates. So the buy rating on this company then dropped to around a hold rating. Man, it is really hard to write with a mouse. It dropped down to a hold rating once the CAGR was around a 25% forecast, and then now since it's between around 16.9 to 25 in there, we can still see that it's either a sell or a hold rating, depending on what price point you get this company at. But in the meantime, it seems that this company is somewhat overvalued, at least compared to its peers. Again, even this article reiterates that it's trading at a premium when we compare Palantir to their overall peers. And this is why we shouldn't over-allocate ourselves to singular risky growth companies, because we need to allow ourselves room to average down our average costs. So I like to max out at around a 5% allocation to a risky singular growth stock, and in my opinion, if you're over a 5% allocation, then you're taking on way too much unnecessary risk of losses. But I would love to hear what you think down below, especially if you're deeply read on this company and you probably would have wished you only had around a 5% allocation to this company, and that's just called proper risk management. And then lastly, we're going to talk about the electric vehicle company NIO, which has somewhat popped and then reversed. Right now, NIO, who's an electric vehicle manufacturer, currently trades at around $12.80, while professionals believe the company should be trading between $11.38 and $50.50. Now, I think this is way too bullish of a price prediction. I would gather that a $25 price target would be more than enough for this particular company over the next year. But why are investors so excited about NIO stock right now? Well, for instance, the reason the company popped by around 7% is because China has actually started to relax some of their COVID-19 restrictions, shutdowns, and various policies. And on top of this good news, Reuters actually reported NIO bringing in a record number of November deliveries, which has acted as a phenomenal catalyst for their overall share price. So investors are actually counting on NIO right now to report an even sharper increase in their overall production and output numbers in terms of deliveries for the fourth quarter. And I can understand the appeal here. However, we should always make sure that we manage our risk wisely. We are still in a very negative macroeconomic environment, so we need to prepare ourselves for this company to drop even lower in price before things get better. Essentially, prepare for the worst, hope for the best. But the best news, in my opinion, is the news of the easing restrictions over in China, which is where NIO is headquartered. Also, I've said this in previous videos, when you invest into foreign companies through ADR shares like NIO, you need to understand that you are taking on risk just by investing into other companies outside of the United States. Because if anything were to happen in the political environment between the West and the East, particularly the United States and China, you know that Chinese stocks are absolutely going to plummet. But in the meantime, expect NIO's NIO stock and their share price to remain pretty volatile over the next few months, at least until NIO releases their December delivery numbers, which could either increase the stock price or cause it to fall. Now, I think because the restrictions are being lowered in China, I think they are going to deliver better than anticipated delivery results, causing the overall NIO share price to increase. But that's just my personal opinion. I would love to hear your thoughts down below. Remember to go and smash that like button for more videos like this one, and I will see you in the next YT video.